Right, hi guys. In this video, I'll be talking about the impact of commissions as our profitability as traders and how do we minimize the impact of commissions on our profits. First, understand that in the business of trading, commissions are part of the cost of doing business. In any other business that you go into, you have got certain costs, rental costs, marketing costs, and administrative costs, and so forth. So the same is true in the trading business. And the main cost or transaction cost would be commissions that we pay to the broker, and that's how the broker makes money. So how does the broker charge us for their services? Again, there are two kinds of brokers, or rather three kinds, but I divide them into two groups. Okay, so the first group of brokers are known as market maker or STP brokers, and I've talked about this in the earlier videos. Do watch that to review what they're all about. And these brokers, they charge a markup on the market's bid-ask spread. So whatever is the bid-ask spread in the market, they will quote you 1 or 2 pips higher. And essentially that's how they make money, on the additional markup. Okay, so for example, if the market is quoting at 2356, if that's the market's quote, they will quote you at 2357, 1 pip more, and that 1 pip goes to them as the broker. That's how they make money. On the other hand, ECN brokers, they do not mark up on the bid-ask spread. So whatever spread you see is the market spread. So in that way, how do they make money? They simply charge a fixed commission. The lowest commission I've seen is the one I'm using, which is halifax.com.au. They are charging $3.50 per lot. So again, one lot is 100,000 of the base currency. So for every one lot I trade, they charge me $3.50 to buy and $3.50 to sell. So when you buy and sell, it's known as a round trip, right? You open and close the position. So the total commission I pay is $7 per entry and exit per lot. Okay, so if I trade 2 lots, it'll be $14, 3 lots will be $21, and so on and so forth. Let's take a quick look at what the bid-ask spread looks like. Alright, so I'm using Halifax, and you can see this is ECN. So ECN basically means that, again, the broker doesn't mark up on the spread. So right now, this is the spread on Euro USD, which is 2442, 2442. All right, so more or less, the bid and the ask price is very, very close, less than 1 pip apart. Okay, so there's no markup. Okay. However, if you see on the left, this would be a typical market maker broker where they will not quote you the market price. They will do a markup, right? So you can see that on this one, this bid and ask. So if you're buying at this price. You're selling at this price. And you can see the difference is 2443 and 2448. So in this particular case, during this time, you can see the spread is pretty wide. It's almost a 4 to 5 pip spread. So the broker is basically marking up by about 4 pips to 5 pips. All right. If you look at dollar yen, again using the ECN, you can see that currently the spread again is very tight. It's less than 1 pip spread. So you buy and sell basically the same price. But if you take a look at this one, which is again the market maker broker, the quote is 10854, 10859. Okay, so again it's about 5 pip markup, right? So again, I understand that depending on your country, you may not always be able to get ECN brokers. But if you can get an ECN broker, get an ECN broker. I know in some countries you can't. You have to use a market maker or STP broker. So if you have to use that, have one that puts only a very small markup on the spread, a maximum of a 1 pip markup or 1.5 pips and not more than that. All right, so let's take a look at how the two different kind of brokers would charge you. So let's imagine you want to buy Euro USD. You think it's going to go up, you're going to go long. So say you go long one lot of Euro USD. So again, one lot is 100,000 of the base currency, which is 100,000 euros. Okay, so let's imagine you're buying 100,000 of Euro USD. You're buying it at 2434, and eventually you exit at 2454. So you've just made 20 pips, right? 20 pips. So how much is one pip? One pip is roughly $10 per lot that you trade. So every one lot you trade, one pip is equivalent to $10. So you just made $200 in this trade. But we have to take into account commissions, okay? So if you use a market maker or STP broker, what would have happened would be when you bought it at, you intended to buy at 2434, but they would have marked up one pip, for example, right, at 2435. So what you're essentially buying at is 2435, not 2434. So basically it's costing you one pip, right? And again, one pip is $10, right? So that's your cost of getting into the trade. And when you exit the trade, you intend to exit at 2454, right? But in actual fact, you are getting 2453, which is again one pip less than you should get because of the markup in the spread. So again, to get out, it costs you one pip, which is again $10. So the total cost of your in and out, your round trip, is $20 per lot. So if you think about it, out of $200 that you made, 20 bucks goes to the transaction cost, or about 10% of your profits. If they were to mark up by one pip. Of course, if they mark up by more than one pip, then it'll be even higher than that, okay? Now, if you use an ECN broker, what happens is when you buy at 2434, there's no markup, but they charge you a fixed commission of $3.50, in the case of my broker, at least. And when you sell at 2454. Right, sorry, this should be 2454, right, typo over here, 2454, yeah, there you go, right? And again, you pay a fixed comm of $3.50. So the total commission you pay would be $7 per lot, right? So $7 out of 200 bucks, again, that is the percentage of your profits that goes to your transaction cost. So you can see that if possible, right, ECN brokers would be a better deal, right? There are many traders out there who say, hey, you know what? I don't like ECN because I have to pay a commission, but for this, I don't pay a commission, all right? But what they don't see is that in actual fact, by having a wider spread, it actually costs you more money than just paying out a commission upfront. That's why I prefer ECN brokers when they are available. Okay, now the other thing to understand is that how much commissions you pay when you place a trade depends on the number of lots you trade or your position size, okay? So the bigger the size of your position, the bigger the number of lots you trade, the higher the commissions you pay for a particular trade. Now, what determines the number of lots you trade? Or what determines your position size? Well, the number of lots you trade depends on how close your stop loss is, all things remaining equal. So, if you remember this formula under the lesson of position sizing, you know that you calculate the number of lots to trade based on, of course, your net liquidation, which is the size of your account, multiplied by your risk per trade. All right, so for example, if you have a $5,000 account, okay, that's 5 grand, that's your net liquidation, and say you are risking 3% risk per trade, okay, and the dollar value per pip is, for example, 10 bucks. Okay, and the other thing that makes up this equation would be your stop loss distance. Is your stop loss 8 pips away? Is your stop loss 20 pips away? So on and so forth. Okay, now the only thing that you can really control on a trade by trade basis is really your stop loss distance. Okay, your net liquidation doesn't really come into play here, and neither does your risk per trade. It's really your stop loss distance. So the smaller your stop loss distance, the bigger the number of lots you trade. Does that make sense? So for example, if your stop loss distance is 8 pips away, you are trading more lots and paying more commissions. If your stop loss is, say, 20 pips away, you are trading less lots and paying less commission. Let's take a look at how this plays out using one of the position sizing calculators. Okay, so this is one of the position sizing calculators that I use. It's available online. But just to show you, for example, if you have an account size of $5,000, again, it could be 10 grand, 100 grand, doesn't really matter, and you are risking 3% risk per trade. Now remember that this has to be consistent for every trade you take, okay? And say you're trading Euro USD, and in this particular trade, your stop loss is 8 pips away, which is the minimum stop loss distance, okay? And if you click calculate, this would mean that to take this trade, you will be trading 1.875 lots, okay, 1.875 lots, right? And again, if you're paying commissions of $7 per lot per round trip, that's 1.875 times 7, that's $13 commissions, right? Times $7, that's $13 commission. Okay? Now, but in another trade, for example, if your stop loss happens to be 20 pips away, okay, notice in this case, the number of lots you trade is now 0.75. So you actually trade less lots. So if you multiply by $7, you get commissions of $5. All right, so you can see that again, the tighter your stop loss, the higher the commission you pay for a particular trade. All right, so like I said, the tighter your stop losses, the higher your cost of trading. And some of you will be wondering, so Adam, in that case, why do you put the stop loss so close at 8 pips or 10 pips? Why don't you place a stop loss, 20 or 50 pips away, a wider stop loss, right? Well, reason is really simple. Again, remember that when you are a day trader, you are getting in and out really fast within a day. In fact, you like to take a few trades in a day. I take up to 3 trades in a day. All right. So when you take really short-term day trades, your stop loss has to be really close so that your profit target can be reached really fast. So while when you place your stop loss tighter, yes, it leads to higher cost of trading, but it also allows you to trade with greater frequency. Does it make sense? Because, for example, if I put a trade where my stop loss is 100 pips away and my profit target is 150 pips away, guess what? It's going to take me much longer for my trade to reach its target profit. It won't, I will not reach it within a day. I'll reach it within a few days or a few weeks. So because of that, I can't place that many trades. Does it make sense? But if my stop loss was to be, for example, 10 pips away, and my profit target is 15 pips away, I can reach 15 pips a lot faster in about 1 or 2 hours. So because of that, I could place more trades a day, and that leads to higher trade frequency. So higher trade frequency means more pips I could make per pips risk. Sorry. So remember that every time I place a trade, for example, if I'm risking 3% on the trade, so if it's a losing trade, I lose 3%. If it's a winning trade, I make 4.5%. I'm risking 1 to make 1.5, right? So if I take 1 trade, I could potentially make 4.5%. If I take 3 trades a day and all 3 are winners, I could make 4.5 times 3. I could make 13.5% return a day if all 3 trades are winners. So that's a trade-off you have to make, okay? And again, the tighter your stop loss, the faster you will reach your profit target, like I mentioned. It's faster to reach 15 pips than 150 pips. So there's always a trade-off there. Now again, if you remember in lesson 1 in this course, I talked about different kind of traders. You have got position traders that hold their trades for weeks or months or even years. You've got swing traders who hold their trades for a couple of days, right? Now, if you are a swing or position trader, you are in the trade for a few days, a few months. So your stop loss is usually much further away, 30, 100, 200 pips away. So when you've got a very wide stop loss, the number of lots you trade would be less. And so as a result, you worry less about transaction costs. Transaction cost makes up a smaller percentage of your profits, okay? But if you are a day trader like me, where again, we are in and out a few times a day, and your stop loss is tight, then you are more sensitive to transaction costs, okay? So you may say, okay, so what's the point, right? The point is this. As a day trader, if my stop loss is 8 to 9 pips away, I tend to now place a profit target of at least 1.6R. Now I know I've mentioned in the earlier videos that I target always 1.5R, and I used to do that, all right? But recently I found that to be more profitable, I would target 1.6R of profit if my stop loss is 8 to 9 pips away. So in other words, if my stop loss is 8 pips away, my profit target will be 13 pips away. So I'm risking 1R to make 1.6. If my stop loss is 9 pips away, my profit target will be 14.4 pips away, which is again 1.6R profit target. I'm risking 1 to make 1.6. Okay. Reason is very simple, because when I got a tight stop loss, I've got higher transaction costs. So I have to make a bit more profit to make it worth my while. Okay, so that's what I tend to do right now. But if my stop loss is 10 pips or more, then I would still stick to a 1.5R profit target, because anything more than 10 pips, like 10, 12, 15 pips away, the transaction cost as a percentage of your profit is much lower. All right. So that concludes this lesson on the impact of commissions on your trading business. If you've got questions, do send me an email. It's Adam Khoo. May the markets be with you.